if we go back to 2009 at the Pittsburgh Summit, there was a clear consensus and a clear commitment that the issues regarding developing the regulatory agenda for the financial services sector require an international approach, and that there was a need for a global understanding as to how that agenda was going to be developed and how it was going to be implemented. Since then, we have developed that agenda. Countries are now focused on implementing that agenda. But at the same time, there has been a proliferation of measures at the national level, not always in a coordinated and harmonized way. We have seen approaches by individual jurisdictions about trying to find a way to localize resources, capital, liquidity. In some way, this has been done in cases through ring-fencing approaches or hard prepositioning. But obviously, fragmentation not always takes the form of preposition or ring-fencing, but there is also fragmentation in other areas. We've mentioned in cyber, we've mentioned in AML, and then data localization, as you all looked at this morning. So it's very positive that the FSB, the G20 first, and then the FSB has recognized this as a main priority. The IIF produced a report at the beginning of the year, and then the FSB in June produced a report to the G20. All those efforts led by Rioso. So first of all, I wanted to commend you for your work and your leadership in this space. 5 days ago, there has been an update, a progress report to the G20 by the FSB. And a number of issues were outlined in that report as to the priorities and next steps. So my first question, Rioso, was precisely, what is in that update report? How much progress have we made? And what is the work plan going ahead?
Okay, Andres, thank you. In June in Osaka, G20 leaders welcomed the FSP and the IOSCO report and declared they will address unintended negative effects of market fragmentation through regulatory and supervisory cooperation. So the market fragmentation issue is clearly back on the global agenda. And also the FSB report, IOSCO report identified issues, clarified concept, and the area for further work. But the real action to address fragmentation is to be taken from here. And the FSB report identified 4 areas for further work. The first one was deference in OTC derivatives market regulations. And this part is conducted by IOSCO. And IOSCO will discuss how to do it at their board meeting end of this month. So I cannot speak for him, but I hope they will agree to come up with a kind of a good practice report on deference. You cannot harmonize deference practices. Well, Europe, US, Japan has a different legal framework for deference. Even the name differs, mutual recognition or substituted compliance. But there can be many good practices simplifying the process, making the decision more focused on outcome rather than article by article comparisons, focusing on technical difference rather than political issues. So the first work would be done by IOSCO. The second issue is ring fencing and prepositioning of capital and liquidity in international banking. Maybe this is the most important fragmentation issues vis-a-vis global financial stability. But at the same time, this is kind of a zero-sum game issues. Host and home interests not necessarily coincide with each other. So many people agree that this is the highest hanging fruit within the market fragmentation issues. But as a first step, we had a workshop of resolution authorities, supervisory authorities, industry and academics in Philadelphia. The Mike Gibson of the Federal Reserve took the leadership in organizing the workshop, and FSB chair Randall Close made opening remarks. I think workshop succeeded in clarifying issues and identifying broad direction of way forward, how to balance flexibility and certainty in resolution, how to come up with a configuration of common and separate interests of host and home authorities. So we plan to distill findings and the issues from the discussion and use it for further work at the FSB. The third area is kind of a preventive effort, so that to use FSB as a forum for national regulators can exchange views at an early stage. We tend to complain after the whole national process is completed. Or Japan FSA writes to European Commission complaining letters after the Troika process started, but it's usually too late. So we plan to use FSB, particularly SRC, for early conversation for national initiatives which would have extraterritorial implications. The fourth area is effects analysis. Currently, the analysis on our reforms in too big to fail areas is going on, and the work would incorporate market fragmentation element in the analysis. Then I covered many areas, but the one area missing is the data localization issues you mentioned. And the data localization issue is, in a sense, wider than financial sector policy issues. So at the moment, FSB hasn't started work on it. But let me advertise it. In Osaka summit, Prime Minister Abe proposed data free flow with trust. And so in WTO, the broader work on data free flow has commenced. And also recently, Japan concluded data issues agreement with the United States. And it includes the article, both sides would avoid data localization requirement so far as regulators have immediate, continuous, reliable access to the data. So FSB is not addressing it, but in wider context, progress is being pursued.
Yeah, and I want to get back to that issue later on during the panel. And I'm going to alter a little bit the order here on stage and go next to Mark. Ryoso has talked about this zero-sum game in the relationship between home and host supervisors. And there seems to be a decision, or at least an inclination, to resort to prepositioning as a way to address some of these home-host tensions or issues. Could you tell us, from the public sector perspective, why prepositioning is seen as the solution to these tensions, or what is it the main tool to address home-host relationships? And from a Fed perspective, how do you come to that issue?
Sure. If you'll permit me to offer a few preambulatory architectural comments before I answer your question
Absolutely.
directly, that'd be awesome.
Yes.
I do want to put in context a little bit the fragmentation debates. I think the fragmentation project of the FSB over the past year and over the coming years is one of the most important projects that the FSB has on its plate. And we at the Fed internally are doing a lot of work on this issue too, so it's a very important issue. But at the same time, I think it's important that we keep in mind a few useful contextual facts. One is, and you mentioned this earlier, Andres, the global regulatory community set out in 2009 to implement pretty significant changes to the regulatory framework for global banks. And it's pretty impressive, I would say, what did get accomplished. Back in 2007, we had really a single rule that applied to global banks, a risk-based capital rule. We now have a risk-based capital rule, a leverage rule, a short-term liquidity requirement, a medium-term liquidity requirement, a large exposure regime, a TLAC requirement, swap margin requirements, an agreement on resolution frameworks, the key attributes. I would not have predicted in 2009 that we would have been able to reach an agreement on all those different things. So this is a little bit of a global harmonization achievement over the last decade. It's actually, I think, pretty remarkable. And it's, I think, useful to keep that in mind as we think about the places where maybe we're fragmenting and we should try to reduce some of the fragmentation. The other thing I think is useful to to think about the context for these decisions and policy debates is if you look at the overall trends in global financial integration from the crisis, and the FSB has written about this in their annual report a couple of times, the trends are actually positive. The pace of growth in global financial integration has slowed since the crisis, but it remains a positive trend. If you measure global financial integration very broadly, summing up foreign direct investment, equity portfolio investments cross-border, bond investments cross-border bank lending. It is true, however, if you look at the sub-chunk of global finance, which is cross-border bank lending, there has been a significant retrenchment. But again, I think it's useful to dig a little deeper geographically into what's going on there. And the story is a predominantly Eurocentric story that involves European banks retrenching from cross-border lending, and involves non-European banks retrenching from lending into Europe. That doesn't dismiss the problem. There are some fragmentation issues that we need to carefully think through and work towards solutions on. But I think it's useful to, again, set sort of the geographical context for that. The Fed did decide in 2014, one of the lessons that we learned from the financial crisis was that we need to strengthen our local requirements for foreign banks. That was driven by a number of realizations. What happened in the United States, say, from the early 1990s to 2007, the eve of the crisis, was we did see really a transformation of the presence of foreign banks in the U.S. markets. We saw the foreign banks significantly grow their U.S. presence faster than the U.S. banking system. We saw them specifically increase their presence in capital markets activities, very interconnected, complex activities. At the eve of the crisis, foreign banks owned 9 of the top 20 broker-dealers in the United States. They also very significantly increased their levels of short-term wholesale funding, so that, for example, on the eve of the crisis, about 3/4 of the top 50 borrowers from U.S. money market mutual funds were foreign banks. And they also shifted their positions in the United States from what had historically been, there was kind of a rough balance between foreign banks that were sucking dollars out of the United States to fund global activities or sending dollars into the United States to fund US lending. But from the early 90s to 2007 or so, we saw a very substantial development of net due from positions. Foreign banks were, on an aggregate basis, using the US to obtain funding to finance global activities. All of these things resulted in our view, some substantial contributions by the foreign bank community to the financial crisis in the United States in 2007, 8, and 9. Substantial runs on the U.S. presence of foreign banks and disproportionate use of our lending facilities. We decided as part of the reform kit that we developed after the crisis that one thing we needed to do was to toughen our regulation of the U.S. operations of foreign banks. In general, we still view what we did there as catching America up to the rest of the world. Because of some of the vestiges of Glass-Steagall, we did not wrap the standard bank regulatory rule kit around the U.S. operations of foreign banks. The investment banks in particular sort of escaped that. So mostly we view what we did there as just catching us up to the pre-crisis standard way that countries regulated the local operations of foreign banks. We also tried to be careful in doing that to strike the right balance, and I think in all of these debates, striking the right balance is the thing to do. So, we did not require full pre-positioning of capital and liquidity for the U.S. operations of foreign banks. Foreign banks remain free to branch in the United States. We generally only imposed tougher regulations on foreign banks that had at least $50 billion in U.S. assets, and the really tough requirements on the ones that had more than $50 billion in U.S. subsidiaries. And then in a number of ways, we didn't impose the same set of requirements on the U.S. intermediate holding companies of foreign banks as on a U.S. bank holding company. We didn't apply the internal ratings-based capital requirements. We did not apply GSIB surcharges or DSIB surcharges, and we gave a little discount on TLAC consistent with the FSB standard, at the north end of the FSB standard, but a
Pretty
discount.
north.
But a lot of what we're doing now is kind of reassessing whether we've gotten the balance there right, and we can talk later about some of the things that we are doing and will be doing to kind of reassess the fragmentation question.
Thank you, Mark. Yes. Deborah, I'll go next to you. And when Rioso was going through the whole list of potential measures and areas to address, it was a fairly long list and quite ambitious in terms of the scope. So how can we prioritize in sort of that long list of issues to be tackled? And where do you think the priorities are?
So first, I would just say that I want to commend again the decision to take up market fragmentation at the FSB level. I think looking at these issues at a global level and having it as part of the FSB agenda on an ongoing basis will be important to do what Mark described as looking back after all the incredible progress that has been made and seeing what might need to be adjusted. And in particular, focusing on it with a financial stability lens. What are the most important things to address? And you've gone through that list. I think from a prioritization and progress perspective, there are actually competing points of view in the sense that you could say that you can make progress more quickly on those issues that are in the remit of the FSB members, where they can sit around a table and discuss these issues and come up with approaches. I think where it's more difficult to make progress are when some of the factors are coming from outside, political factors, as well as, you mentioned, data localization, where it's not just an FSB issue. That being said, I do think it's important to not lose sight that some of these issues are quite important to address as well, and should not go lower down on the chain of prioritization just because they're difficult to deal with, and you've described some of these as the high-hanging fruit. I think it's also useful to think about prioritization and the approach that the FSB could take in terms of the stages at which some of these fragmentation issues arise. This was mentioned in the report and recently mentioned in some of the speeches that have been given on the topic. You can look at these issues arising at three different stages: when policies are being developed, when policies are being implemented, and then the evaluation phase as well. So there's a lot of good work that could be done at the level where policies are being developed. If we can get in front of some of these issues on a going forward basis, that would go a long way to addressing some of these issues before they become issues. And some of the evaluation work that's been going on now at the global level has identified some things that need to be addressed and changed, but it would be much easier to do these things in advance. So I think using the FSB as a forum for forward-looking discussions would be a positive development, because there perhaps in some cases can be legitimate alternative approaches that could be taken for regulation and supervision that would avoid some of these issues of fragmentation. As far as implementation, there's a lot of good work going on keeping an eye on global standards and timeliness of implementation of those standards. That is something that probably should continue to be under the umbrella of fragmentation. There are some standards that have more impact on those types of issues than others. And we would hope or suggest that those things as well could be monitored through the FSB with a view on fragmentation. We also think, and some of this was mentioned in the original report on fragmentation, that some of the existing tools that are in place, such as supervisory colleges and crisis management groups, could be further leveraged to have discussions on a firm-specific basis among supervisors about where the pain points are, and particularly those that we think have an impact on financial stability. So that's another area where we would suggest some further focus, and some of this was outlined in the original report. And then lastly, with respect to evaluation, there's been a lot of good work already done. The review on TLAC implementation has brought to the forefront some of the issues around the proper balance of pre-positioned resources versus flexibility to send resources where they're needed in times of stress. I'd say this is a top priority. The poll showed it. There has to be some will to address these issues, understanding that some of this is in legislation, but more education about what the real problem is and how rigidity in the system could actually be a problem in times of stress. Now is the time to address this when we're in peacetime versus when we're in a stress situation. So we still would continue to put that at the top of the priority chain. And then the last thing I'll mention, and it goes a little bit to Mark described the framework in the US, is I think that the issues on fragmentation can be different depending on where your home jurisdiction is and where you operate. So there can be some distinctions based on that. And one of the things that we think could be useful to do under the umbrella of this fragmentation work is look at what's been imposed below the consolidated level of organizations. Other than internal TLAC, most of the focus at the international level has been on the consolidated entity, and I think it could be useful to do some type of a stock take, not necessarily with a view to developing standards, but to understand more the evidence of where this fragmentation exists.
Faryar, let me go to you next. Maybe here on stage and probably here in the room, we take it as a given that fragmentation is a problem and that we need to address it. But, for an internationally active firm like Goldman Sachs, why is this a priority? What is the impact of fragmentation? And from your own perspective, you've been, in the public sector and the private sector for a long time. A path forward in addressing some of those issues.
Yeah, it's an interesting question. I think there's a perspective that banks certainly have in terms of the ability to operate effectively and efficiently, manage their costs and their risks as effectively as possible. And fragmentation ultimately impedes that to the extent you have both on the market side as well as on the prudential side an impediment to operate your institution on a most efficient basis, which would be on a global basis. It ultimately has impacts in terms of the running of the business and the profitability and our ability to serve clients as efficiently as in as many markets as possible as they want to be served. But in answering that question, I'm a little bit taking a bit of a pause because Himino-san and the work at the FSB were quite clear that the framework around which the fragmentation agenda has been taken up by the FSB and the G20 and the IOSCO and everybody is through the lens of financial stability. And I think that's useful so that this doesn't get misconstrued as another sort of strand of pleading on the part of the industry about regulatory burden, unnecessary cost, things of that sort. Obviously, those issues are relevant, and regulators, when they can, will assess them, but they never have the same urgency as they do as the core framework around this work plan, which Himino-san's been quite clear on from the beginning of this exercise, which is, are there areas of fragmentation, unnecessary fragmentation driven by regulation that ultimately impede or undermine financial stability? And then the next order of issues would be potentially looking at issues so long as they don't have an adverse effect on financial stability. And I think that's the right sequencing and the right framework to look at it. I would say in terms of I would sort of say two different things. One is, I think for all of us who worked on the Basel III revisions or the Basel Endgame, or what a number of us in industry call the Basel IV package, it was interesting that work obviously took quite a number of years. But one of the interesting interventions that happened was that when the G20 finance ministers declared at a very high policy level that there should be no significant increase in capital resulting from that work. Now, the nature of the prudential work and the Basel rule development is obviously by definition quite technical and quite complicated. But I think it was quite a powerful governor that more so than most of us anticipated when the finance ministers essentially said to the experts that however you land on this, let's make sure the net impact of this isn't dramatic in terms of the net overall capital increase resulting from all the various elements of that broader package. And that, the regulators on the panel can speak to that better than I can, but I think for people like Deborah and myself who looked at this from the outside, it felt like it was an important benchmark against which the experts had to measure their work, which got quite technical in nature. And I think with that experience and that lesson, I think the fragmentation agenda has a similar sort of dynamic that has not yet fully gelled, I think, is my guess, although we'll learn over the course of the next months and years in the sense that you have the leaders now, not only the finance ministers, but the G20 leaders on record now saying, whatever else you do, fragmentation is a critical issue that needs to be addressed in your work. And so when you ask the question to Deborah, Andres, about prioritization, and your poll at the outset suggested, in essence, that from the prioritization that maybe there would be a sequencing that the regulators would pursue. I would actually say that's actually in some ways not the right way to think about it, because there's a lot of, and I was sort of taking some notes as we were talking about, but there's a lot of issues. Governor Quarles has raised potentially the reassessment of the calibration of the internal TLAC guidelines. But there are a number of other sort of issues that have significant fragmentary implications. Brexit, potential CCP localization requirements coming out of Europe, the CFTC's potential re-examination of the CEF rules, the sitting of crisis management groups and supervisory college as an ongoing basis, looking at institutions like ourselves. I think all of those are important triggers that are in front of us immediately, that the fragmentation priority that the leaders have been set becomes a useful discipline to make those processes better. Is localization the priority, or is there a fragmentation concern that should offset that? Is Brexit purely a political exercise of division, or is there a concern about fragmentation that has systemic and other implications that should mitigate and moderate some of the reflexes that would otherwise be brought to bear in the negotiations of how Brexit lands? And then the sitting of the supervisory colleges. We've seen it for ourselves that sometimes the makeup of the number of regulators around the table doesn't feel as complete as it could be, given the nature of the breadth of the geographic reach of the markets in which we operate. And I think the fragmentation framework and the concern that's been set at the high level, I think, is useful in making those processes better than they would be otherwise.
Ryoso, I'll come back to you. When you were describing that zero-sum situation, I think in one of the meetings that we had, someone talked about a prisoner's dilemma also in the home-host relationship. And at the end of the day, it's a matter of trust between home and host supervisors. Are there tangible ways in which cooperation and coordination between home-host can be effectively improved? Besides devising a regulatory and supervisory framework with very clear rules, in terms of the relationship between the home and host, any tangible ways in which that can be improved, that relationship?
Yes, when we talk about cooperation and trust, international organizations tend to make a preach on the importance of trust.
Right.
And people tend to think if we communicate more, the trust would be improved. my view is it's not enough. And preaching trust wouldn't create trust because each national authority is mandated to maximize the interest of constituencies. And so the only way is to have kind of enlightened views on one's own self-interest. For example, as a home authority, you want to secure as much resource as the headquarters so that it could be allocated where it is needed. But at the same time, for home authorities, it is also a self-interest. Local hosts have some confidence in the kind of orderly solution secured as a group and also in local entities. So maybe certain prepositioning would enhance the confidence in local authorities and maybe increase the probability of orderly liquidation rather than disorderly one increased. And also, I'm a home authority to certain Japanese banking groups. But if I'm also a host authority to banks abroad. So the self-interest has lots of dimensions and elements. And I think the starting point is to have a broader, longer-term view on self-interest. So solution wouldn't be kind of disregard of self-interest and preaching cooperation, but rather how better to kind of combine various elements of self-interest into a coordinated action. A bit abstract, but...
No, that's incredibly helpful. Mark, you made some reference to the issue of liquidity and funding. And you very clearly stated, in the US, we still have a framework where subsidiaries and branches can fully operate. The Fed did floated some ideas, let's say, not effective proposals, floated ideas about liquidity requirements for branches, which is now a topic that is being widely discussed in the international fora. Tell us, the origin of those ideas, any concerns behind those ideas, and then ultimately the decision that this needed to be an international discussion.
Yes, we've been spending quite a bit of time. One of the main themes that Vice Chairman Quarles has had us working on the regulatory machinery inside the Fed is on the fragmentation cluster and the appropriate way to regulate the U.S. operations of foreign banks. The branch liquidity is one of the substreams under that work. Let me just touch a little bit on some of the other strands, and then I'll talk about the branch liquidity in more depth. A couple of things that we've done just over the last month, which I think can be appropriately pitched as modestly to moderately defragmentary, we did last week finalize a new tailoring framework for regulating the U.S. operations of foreign banks. It's quite similar to the new framework we adopted for the U.S. regional bank holding companies, very similar risk-based factors and thresholds. The net impact of those proposals are to slightly reduce the capital requirements for the U.S. operations of foreign banks, slightly reduce the liquidity requirements for the U.S. operations of foreign banks. As a group, in the aggregate, different banks will move up and down based on their risk profile in the U.S. But I think net writ large, it's a modest reduction in some of the pre-positioning requirements for foreign banks in the U.S. Another thing that we've done in the anti-fragmentation work is, as part of our reassessment of the Volcker rule, we focused a lot of energy on assessing the extent to which it's extraterritorial in its application. And we found quite a bit of extraterritorial application. And in the final rule that the agencies approved recently, we softened, I think, in some quite reasonable ways, the eligibility requirements for foreign banks to use the outside the United States exceptions in the rule. We also took a look at the way our compliance program requirements and metrics reporting requirements applied to foreign banks. And we had, in the original rule, decided that those should apply based on the global trading profile of a foreign bank. We decided that was a piece of extraterritoriality that was not efficient and not necessary, and so we moved for foreign banks to look only at their US trading profile. So I think the whole Volcker proprietary trading moves that we've done recently have also been defragmentary in nature. Volcker covered funds coming next. On branch liquidity, it may sound on the surface like it's some kind of a pro-fragmentary idea that we're kicking around, and I would start by saying I don't think you should look at it that way. Clearly, part of what we did in our foreign bank rules back in 2014 was to focus on getting more liquidity resources in the United States to back the US liquidity risks of foreign banks. But at the same time, we recognized that branches were special. So what we did is we imposed kind of 30-day requirements, stressed outflow requirements on the intermediate holding companies, but we did more of a 2-week requirement for branches based on the bank's own internal stress testing. So we recognized early on that a softer approach to branches was appropriate. We now moved as part of some follow-on rules to impose standardized liquidity requirements on the intermediate holding companies of foreign banks. We have not done that to the branch. And so the issue that we want to spend some time talking to our international interlocutors and also doing more thinking domestically on is, would it also be beneficial for the system to have a more standardized liquidity framework for branches of foreign banks? Again, the vision is not we feel like we've got too few high-quality liquid assets in the U.S. branch networks of foreign banks. I think, in general, in the aggregate, we're comfortable with the levels of pre-positioning of liquid assets in the U.S. branch networks of foreign banks. But right now, how we decide what the right amount of HQLA is in the U.S. branch is determined primarily by the bank's own internal stress test with some supervision, and that produces differential results, heterogeneity from bank to bank, and also might over time produce more pro-cyclical requirements. So we want to at least spend some time thinking through whether it might be useful to supplement what we've got now with some kind of a reasonably calibrated, standardized branch liquidity requirement.
So next step is an international discussion
Yes.
with your peers on this topic.
Yes.
Deborah, I mentioned that I wanted to go back to the other issues. I mean, we've spent good time talking about prepositioning and internal TLAC and some of those challenges, but data localization was mentioned as one of the areas. So in those areas where fragmentation is also present, how do you think we should take this forward?
Yes, there are other areas where fragmentation is certainly an issue that goes directly to financial stability. And one of these areas is around data standardization, where there's been a lot of progress, but it doesn't seem to get the attention and the level of focus on implementation at the national level that some of these other issues have in terms of accountability. And this is one that was part of the original mandates post-crisis and is really a common sense approach. When regulators, supervisors are looking at information, they should be looking at the same set of information around the legal entity, so the LEI, the legal entity identifier, and in the derivative space, data standards relating to the types of products and the types of transactions, the UTI and the UPI. And this goes a long way to financial stability because it goes to the usability of the information, the ability to aggregate the information, to use it for monitoring, to use it for risk management, and to use it in times of crisis. So there has been recently a thematic review on the adoption of LEI at the FSB level, and in the letter that the FSB chair just issued to the G20 said there's been a lot of progress on LEI, but we still have far to go. So this is another area that we think would make sense to be under the umbrella of fragmentation. Sometimes it gets described as a cost issue. And yes, it does involve cost when you have multiple reporting requirements and everything is a little bit different in each jurisdiction. But it really is less about cost and efficiency, although that's obviously very important, but at the end of the day, it's really about the usability of the information. So that's another area of focus that we think could use more attention in terms of education of the importance of adopting these standards at the national levels. And although it may be a short-term cost to change systems and the like to adopt these standards, the long-term benefits, we believe outweigh the costs. The other area, of course, is around cyber, where some good work was done on the stock take by the FSB, which really showed the fragmented approach that's taking place across the globe. There, once again, important from a financial stability perspective, not just a cost of compliance perspective, because the more time that's spent on dealing with disharmonized approaches from a compliance perspective really takes away from the actual objectives of security around cyber. So the development of the lexicon and some harmonized approaches to the supervisory framework, like the financial sector profile and the like, we're quite supportive of, and we think this could go a long way as well.
Thank you, Deborah. Faryar, I'll go last to you, and you probably had the easiest task of the day, which is to sum it up and give us the way forward on this topic.
In 1 minute?
Yes.
I was rereading a speech Augustine Carstens gave, which is not very different from a number of other speeches that policymakers have given over the last few months on the issue of kind of the forward agenda on regulation. And it's interesting, the framework he laid out, which I think it makes sense, is that there's essentially 3 phases of the post-crisis regulatory work. It was the design of the rules, the implementation, and now we're in what he described as the 3rd phase, which was the assessment phase. Right. Which I think, which is where the fragmentation work plan fits in. As I read that, I actually thought that, and Mark laid the list out quite well. I mean, there's been an extraordinary amount of rulemaking that's occurred post-crisis. And in a way, we've reached the limits of what regulations can do in terms of addressing the lessons of the crisis. And there certainly should be, as Augustine said, a reassessment of the rules, measuring for whether they're being effectively and consistently applied, whether they're fragmentary in nature, whether there's unintended consequences. All of those things are quite healthy and helpful. But I think all of that only can be done well if there's a reassessment and a repositioning in a more prominent basis the role of supervision. And I think the subtext of a lot of what we're talking about, which we shorthand as trust, which I don't think is quite the right way to look at it, is the degree to which supervisory authorities across different jurisdictions can find the right balance between their important imperatives and prerogatives to protect the home market vis-a-vis the kinds of abilities they want to have in terms of home institutions being able to operate on a global basis. I think Himino-san's balance is a particularly balanced one because of the nature of Japan's market. It's a large, important, complex market that has a lot of international players, but it also hosts a lot of really important global financial players who are, or is the home to, that are hosted in other jurisdictions. And I think other regulators have to take that assessment on. I mean, one of these areas where this could play out, I think importantly, is in the Basel Committee agenda, for example, where under Chairman Ingves, there was a reassessment and an audit of risk weights in the trading book and the banking book. It was a lot of complicated work, but it really revealed a lot about what's happening in terms of supervisory practices. The degree to which the international standard setters do more and more work on assuring in themselves around the consistency of not just regulation, but supervisory practices, I think it makes the fragmentation agenda easier to implement. Because the framework is one of more transparency and earned trust, I guess I would say, among the supervisors.
No, and I thank you for that, because you also are setting up our next discussion, which is about the evaluation and the assessment. So please join me in thanking this panel for this great discussion. I'm sure fragmentation will continue to be in the agenda. I hope it is in the Saudi presidency list of priorities. And I look forward to continuing discussing this with all of you. Thank you very much.